Okay, good afternoon, everybody. Today is Friday, October 6th, 2023. This is your weekly take on the market. It is 12:15 Pacific time. The market will close in about 45 minutes here. I have a meeting that I have to get to, so it was now or never. So I wanted to wait as long as possible because today is going to turn out to be probably a key day in the market. I'll be your host. My name is Scott St. Clair. I'm the manager of the Premium Product Group here at Investors Business Daily. Please take a moment to read the disclaimer. I'm not licensed. Nobody at IBD is licensed. We don't make buy, sell, hold recommendations. Uh, our circle of competence, our sweet spot is education and research. So I'll talk about the market mostly. I think I'm going to skip the industry groups for the sake of brevity. I apologize. I don't. I think there's more important things in this time frame in the short window I have here. I want to talk about the market, go over some stocks, and then we'll do the quote of the week. So here are the National Association of Investment Managers. I believe is this number. I took this right from their website and overlaid from the S&P, and the blue number is their I want to say exposure is probably the best way to put it. You can see they've reduced exposure pretty fast, and the market has rolled over. It's probably more of a lagging indicator, or maybe a coincident indicator, but they're it's not quite as bad as the lows in October, but you can see that they've taken off exposure pretty fast in this pullback we've had. I think the S&P 11% off the high. I guess we'll pull that up in a little bit. This was a great chart. The percentage of the contribution of stocks to the S&P's return during positive years. So the 10 largest weightings, I know they talk a lot about the Magnificent Seven, but this is the 10 largest weightings in the S&P have accounted for 96.5% of the performance of the S&P this year. This is a record going back to 1993. You can see 2007, 78%. The S&P was up 3.5%, and so on and so forth. So it's very, very, very narrow market. Breadth numbers are pretty poor. The Russell doesn't participate at all. The equal weight S&P before today, now, maybe after today it's not, but before today was actually down on the year. So it's been a very strange market. And I think it actually contributes to the idea of stock selection, finding leadership, because it's becoming a little bit more narrow and tougher. And the big money runs to all the same names. Today's a good example. It's all the same names, just straight up, and there's no back and fill. It's kind of, I'm looking at the intraday charts. It's, market try to go down, big bar up, and then just relentless the rest of the day. Just every tick is higher. Makes it very difficult. So it could turn out to be a follow through day today. We'll look at that in a little bit. Here's the Russell 2000 overlaid with the NASDAQ, the ratio going back to 1987 and all-time low. Even worse, it looks like, than the 2000 top. So, and the companies, I guess, if you want a reason for this, this is what I love about a chart. You can just observe and you don't have to have any reasons. You don't have to know the why, but, interest rates have gone up a lot. I know they're nominally, it's not like record numbers, but, the move off the lows has been tremendous. And a lot of these companies in the Russell rely on funding. You got a lot of what they call zombie companies. They can't stay alive without rolling over their debt. And that debt is, trebled and quadrupled off the lows. So it's going to be a lot tougher for them. And this chart tells the story. And it also shows why you kind of want to stay with a trend when you have a trend. Because if you fought this since 1997. I mean, you finally had a little reprieve in 2000s. There's a small window where you did better from '01 to '07, and then then a huge another 16-year underperformance window. Be really frustrating. Nobody in the business would survive this type of pullback. It just you wouldn't have any AUM, any assets under management. Okay, so let's pull up the indexes on MarketSmith. Make sure I'm sharing the right screen. I'm going to turn off my camera because I know sometimes that it will cover up the chart. And you can see you've got it had a big day today. Tried to open lower and it's straight up. It's kind of a weird bar. You just don't see bars like that. But sometimes these big bars can lead to big moves. Today will probably be a follow through day. I haven't looked at the volume, but it's probably going to be a follow through day. We're up 1.7%. So we've got plenty of threshold on the upside. And the market never made a new low. So this would be day one here, 2, 3, 4, 5, 6, 7, like a day 8 follow through on the NASDAQ. On the S&P, this is your first day right there. We never undercut that. I don't believe 42.1955. Yeah, so this is day 3 on the S&P. So from a NASDAQ standpoint, you've got a follow through day because the NASDAQ never made a new low. And again, I think I talked about it last time, or maybe I talked about it on IB Live. I can't remember. But you've got a bit of a divergence. When one index makes a new low, but the other one doesn't, that could be a positive divergence, and vice versa. When one index makes a new high, but the other one doesn't, that would be a negative divergence. And it's very subtle. You've got this little double bottom here, but the S&P has been much weaker to the double bottom-ish. And then you've got the Russell. Let's pull up IWM. It's just terrible, right? Just really bad. So the NASDAQ is where all the action is, and that's where everybody's running to today. Tesla was down, now it's up. NVIDIA is up. CrowdStrike and Palo Alto are acting really well. What else is out there? Microsoft, Meta. It's where I don't want to say you can hide, but if you want exposure to the market, you're not going to lose your job as a money manager. That's where you run to. So day one of that might be the case. If this is real, then they'll start to branch out and other names will hopefully start to show up. But it's going to be a follow through day. Act accordingly. If you don't own anything, I think you probably want to own something, 5, 10, 15% exposure. And I'll go through some names that look like they're exhibiting relative strength. And if you have exposure already, maybe you could wait, but you probably want some exposure. Now, is it a short-covering rally? I don't know. I just don't know that many people are short. I hear that a lot. It's a short-covering rally, but I'm a little skeptical. I'm not certain I see that many people that go short. But maybe I'm wrong. Maybe the institutions with the big money got short and they've kind of got caught off guard, and so you get a little bit of short covering that fuels it, and then if it's real, you'll get you'll get more days piled on. As long as we don't undercut these lows, we'll be in a new potential uptrend. S&P, I think I looked at very briefly, but same thing. It would qualify, but it's not day. It's not within the window. So because it made a new low. So this was day 1. That blue day 2. This would be a day 3. So that's why it wouldn't fall into that camp. Let's look at all the stocks. So NVIDIA. So it didn't make a new low. I kind of wish it would have. That would have been ideal. I had kind of a trend line drawn like this that went off on that day, and I did buy it for a quick trade. And fortunately, I'm out. I'm out probably like 30 points ago. But this would be something, look, if the market's going to rally, Nvidia is going to go up. It seems like one and the same, almost impossible for one to go up without the other or one to go down without the other. So Nvidia is a candidate if you need exposure. In the ETF realm, very quickly, let's look at like what the SMH looks like. This looks like a potential double bottom. And the one that I've been short and covered this morning, because I always cover bad opens. And I think it was down 3 or 4 on the open, maybe more. And it's up 10 now. It's huge, huge swing. But this looks like maybe a potential double bottom as well. So I wouldn't be in any hurry to short this as well. I'm not going to go long it. I'm not a big fan of these triple levered. That's why I short this one. But that's another thing that you could look at. Are there any? I looked at emerging markets to see if they're like, is that the spot? And no, this isn't all that great. This is day 2 of a potential follow through day if you're using that. So that's not all that great. I think China is having an okay day today. PDD, I think, would be. So this is my favorite name. If you force me to buy Chinese stocks, this is my favorite one. It's acting great, much better than all the others, but I don't have to own them, which is nice. So I can be more choosy. CrowdStrike, I think, is exhibiting strong leadership. It tried to go up. I think the day I bought it was there when they came out and announced their kind of guided the street on what they expected. And stock tried to go up and couldn't because of the market. But you can see today's action is just resilient. Just every tick is practically higher. So this looks like it's exhibiting leadership. Palo Alto, potential leadership, and QLYS in the same group. Potential leadership. Somebody mentioned Zscaler. It's okay. I mean, look, nothing wrong with that, but I think I own CrowdStrike and I'd rather own the others. I don't think you need to own more than one, but you can. But I think just having some exposure there seems, if this is real, it seems like the area to go to. We probably need some new leadership if this is real. That would be ideal, but doesn't mean it's going to happen. VRT, another go-to stock for me. Looks very good. Look at the relative strength line all the way in new high. It's not really a pivot. This isn't a base. It's too short. So it's a little tricky, but great relative strength name. So NVIDIA, CrowdStrike, VRT, those are the 3 that I mentioned on IB Live this morning is, you need exposure, boom, boom, boom. Just go buy 5% of each of them and see what happens. Or if you already have exposure, however you want to proceed. But in case this is real, you need some exposure. Do you need 50%, 100%? No, but you probably need some exposure. That way you're going to get more feedback than just looking at the market. Your account's going to go up. Might not go up a ton, but it's going to go up. What else is out there? Let's look at like AMD. So it's finally getting above the 50-day, but this has been a tough stock above here. So that would be interesting to see if it can hold those gains. And in other areas like energy, I know PXD got a buyout offer from Exxon, or the journal reported that it's on its way. But let's look at like Tidewater. Right on the 50-day, not doing anything wrong, but not a whole lot there today. Oh, I know, Meta. You got to always look at Meta. Blue dot, RS line, new high. I don't own it, but this is again, it's a very NVIDIA-like. If the market's going to rally, this stock's going to rally. And, it's just, they're one and the same. So this is another candidate. How about Microsoft? Not as good, kind of an ugly double bottom. I would rather buy Meta or NVIDIA. How about Amazon? Not that exciting. That would be a pass for me. How about Google? Google's okay. Yeah, you're practically at a new high. There's the kind of pattern there, but look at the relative strength. So Google would definitely be of interest to me. A little slower because it's so big, but that would be a candidate for exposure as well. So let's go back to the indexes and the follow through day. So let's spend a little bit of energy on this. It's not a perfect system. There is no perfect system. It's just designed to help you recognize when the market has changed, especially when you're almost always going to be negative and or bearish. I always seem to be on follow through days, and that's why having something to help you change your mindset is so key. Is because this kind of follow day is kind of out of nowhere. I thought the market would head fake on the news because that's kind of what it likes to do. It loves to head fake on news. But the relentlessness of the price action to the upside today is surprising to me. And that's why you put something down and see what happens, rather than try to guess. So not all follow through days work. Will this one work? I don't know. I honestly have no idea. I think the market is really tough right here. I could argue either side, and it has been for a while. The market's been very bifurcated. Normally, a market this narrow, when they, Mark Minervini says, when they start to get nicknames, that's usually a bad sign. The Nifty 50, the Magnificent Seven, but that doesn't mean it can't last for a day or two or a week or a month or 6 months or a year. And so you could get left out if you avoid it and or try to get in front of it as far as like shorting it, getting stuck in a freight train move. So I think this follow through day probably has like, I don't know, 60% probability of working, which is fine. And if you're wrong, then you just stop yourself out. And if it's real, well, probably I think Charles Harris thought this was very double bottom-ish, which is good because if this is a double bottom, you have like a quasi pivot way up here. So that means you can literally be buying stocks all the days that the market does that. You have a huge window where you could be buying stocks as long as it stays above here and this turns out to be a double bottom, because that would be a pivot and action point where you could buy if this was a stock. So you have a pretty good window. So put something on, see what happens. And if it's wrong, you'll get just stopped out. I always do like 5% is at least a bare minimum. Like 3 names at 5%, I'm 15% invested long. If I'm wrong, let's say I just get absolutely shaken out wrong. I lose 10% in all of them. They just gap down through my stops. Seems unlikely, but that could happen. It's not impossible. I'll lose 1.5% on my whole account. So I like to do that kind of whole account number. Can I live with losing 1.5% on my whole account? Yeah. I have some gains for the year, and I don't want to lose 1.5%, but I'm willing to risk that 1.5% to maybe make 10 or 12 or 15 if this is a real rally or more. So if you're up 10, 12, 20% for the year, let's say you're up 20% for the year, well, and you're wrong, and now you're up 18.5% for the year. Those numbers are practically one and the same. If you're down 7% for the year, you probably don't want to go down another 1.5. That puts you down 8.5% for the year. So it depends on position of strength, position of weakness, on how aggressive you might want to be. Okay, I think I'm going to jump to the quote of the week. I might have done this one many moons ago. I apologize if I have, but if I have, no problem. We'll revisit it. I think it's a very important one. So if you're going to be a great investor, you have to fit the style to who you are. At one point, I recognized that Warren Buffett, though he had every advantage in learning from Ben Graham, did not copy Ben Graham, but rather set out on his own path and ran money his way by his own rules. So Michael Burry he's most famous for The Big Short, but he actually started out his career as a doctor, and he was on the Yahoo message boards back in the days, and he was a tremendous stock picker. And people were recognizing, hey, who's this guy that's picking all these stocks? That's kind of how he got his start. So even though he's most famous for being bearish, it's not really what he does. He's flexible and more of a value investor versus just being a bear, I guess. But you have to kind of be yourself, find the style that who you are. So I think this applies for me. At one point, I recognized that, myself, though I had every advantage of learning from William O'Neill, I did not copy William O'Neill. I found it better that when I set out on my own path. So there's a lot of things that I do that fit the CanSlim style to a T, but there are some things that I do differently that are more to my own style. And it's just a personality thing. I'm just not good at certain things. And you can either try to build those and get better at them, or just, don't do them. I don't enjoy pullbacks. I'm not good at, I don't care if I buy something 100 and it's 200. I'm not good at watching it, correct from 200 to 180, like maybe Jim Ropel or somebody like that is good at. So I know that, and I tend to get out before it does the 200 to 180. Problem is, I might get out at 170 or something like that before it does that. So I track my equity curve very closely, and I manage the equity curve. So I try to smooth out the bumps, and that works to the downside, but also hurts me to the upside. If you're smoothing out the lumps, then you're going to smooth out the big moves up by selling, some of your winners a little too soon. And I'm working on a Founders Club event where, I'll share all that information, et cetera. So that's kind of what made me think of this. But in the end, find out what style works best for you. Does it have an edge? Can it make money? Are you able to prove that it can make money? That's key, right? Are you making progress? Is the number go up? Is this new book about crypto? But it's really kind of key. Number go up is most important as far as that. Okay, everybody, have a great weekend. Today is, I will be back next week with another video. Here's our contact information, marcusmith@investors.com, 800-424-9033. Thank you, everyone. Have a good one. Bye-bye.